This is Your Money, Your Wealth.
Welcome to another episode of Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. As always, I'm with the big man. He's sitting right over there, Big Al Clopine. Thanks for tuning in. We have a phenomenal show lined up over the next half an hour. Right now, the markets are a little volatile. Are you looking at your investments? Here's what happens when you start looking at your investments. You start to worry. I don't care if the markets are at all-time highs. You worry that the markets are going to go down. When the markets start to go down, you worry that the market is going to go to zero. When you worry, you start making mistakes with your money. That's what's on my mind today. Here we go. We're going to talk about 5 key mistakes that you're making with your money and some strategies on how to avoid them. They're simple things. There's a lot of things that you're doing wrong with your overall investments, and sometimes you don't even know you're making the mistakes. So to help me out with this, let's bring on Big Al Clopine. Big Al, here we are. Second week of the show of common mistakes, and I think it's probably the best time to talk about this when we see a little bit more volatility in the overall markets.
Oh, I think you're absolutely right. And as you said, we actually did this show last week with 5 other mistakes. But this week we got 5 more, and these are probably even more common than last week. So you're going to want to pay attention to how to avoid these mistakes. And starting off right off the bat, we're going to talk about lack of diversification or poor diversification. In other words, you have all your eggs in one basket. And you've heard this before. Don't hold just a few stocks. Have a lot of different investments. So if one goes up or down, it's not going to affect you that much. Number 2 is not enough patience. You know what happens when the market caves? We want to get out, we want to sell, and that's not always the best approach, which we'll get into. And then there's downside exposure that people don't really quite fully understand and realize, which means the market can go down, and it does go down. So what do you do when that happens? We're kind of in a volatile environment right now. And then the next one is really poor allocations. For those of you that feel like you are very well diversified, but you may have all your assets in, say, an S&P 500 fund, and that's a good asset class, but that's not the only one. You'll probably want about 12 or 13 or 14 other ones as well. And then finally is many of you don't have a plan. You don't really know how to invest and what to do in different markets, how much to save, how much you can spend in retirement, and most importantly, how you should be invested. So I think what we'll do today is we'll jump right in, and I want to kick off with a video on Enron. You guys remember Enron? This was over 10 years ago, a disaster that can't happen to any of us.
It had taken Enron 16 years to go from about 10 billion of assets to 65 billion of assets. It took them 24 days to go bankrupt. It's got hungrier and hungrier. Sooner or later, they were doomed to go off that cliff at 90 miles an hour.
It's astounding that they got away with it for so long.
In reality, Enron was a house of cards.
What we didn't know is that the house of cards had been built over a pool of gasoline.
It all sort of became smoke and mirrors.
I think it's important to talk about this because there's such a lack of diversification in a lot of your overall portfolios. In Enron, it's just a classic case, right? It's like, okay, well, that's not going to happen to me. But just talk to the people that had Enron stock back then, and I guarantee you they were saying the same things. It's not going to happen to me. You know, there's a lot more regulation today and everything else, but stocks are volatile. If you own one individual stock, you have the jeopardy of losing a big portion of your overall portfolio. And Enron, I think, is a good piece to educate, to bring people back and say, hey, you know what, diversification is still the only free lunch in town.
Well, I think so, and really when you think about it, so this illustrates why you do need to be diversified. And I'm going to give you a little story. So Enron was...
Is this story time by Big Al Clopine?
It is.
Okay,
it is
all right. Where's the light music?
I know, where's the stinger, huh? I don't know.
I'm going to tell you a story.
Anyway, with that.
Go ahead.
So Enron, it was a disaster for a lot of investors, but it was very personal to a lot of employees, like Tom Padgett, and this is he and his wife Karen. Tom was about 4 or 5 months away from retirement. He was 59 years old. He had $615,000 in his 401k. He had been diligently saving into that 401k $600 per month for his entire career. and they didn't go on vacations or a lot of vacations. They put 3 kids through college. They were about ready to retire. And here's what happened. Of course, Enron, we know, the company went bankrupt in a short amount of time. And his portfolio went from $615,000 to $11,000. $11,000. It went down 98%. And this happened to a bunch of people. So you're thinking, well, how could this happen? Well, he had over 90% of his investments in Enron stock. That's concentrated. That's not diversified. When you're talking about your retirement assets, you want to be diversified. You don't want to be concentrated because you can very easily strike out.
Yeah, I mean, diversification, like I said before, is the only free lunch. But when you look at employers, they have company stock, and then when I'm an employee of that employer, I want to be, hey, I want to get all into the company stock, and a lot of people do that. We see that right here in San Diego. SDG&E employees is a prime example of that. A lot of you have your own company stock, and you have pride within that. I'm not saying don't hold the stock, but you don't necessarily want to ride 90% of your overall wealth in the company, because if you look at this example here, right, he lost 98% of his portfolio, and he also lost his job.
Exactly.
So he doesn't have an income, he doesn't have any assets, and he's 59 years old. Now he has to go back to work. Diversification is the only free lunch. If you take a look at this slide, right, so all right, you never strike out or you never hit a home run. You always want to continue to hit base hits. If you're trying to hit home runs all the time, you're likely to strike out. Babe Ruth was the home run king, but also the strikeout king. You don't necessarily want to have that as an investment strategy.
Well, that's exactly right. And so this is the key, is concentration is not your friend, as I mentioned, in retirement. So what that means then is you're not going to hit a home run. You only hit a home run if you pick 1 or 2 stocks well. If you would have picked Apple or Qualcomm at the right time, you'll hit a home run.
Well, here's the best thing, right? The absolute best investment that anyone can own is one individual stock, by far. That is the best investment you can own. On the flip side, the worst investment you can own is one individual stock. So you don't necessarily know what stock to pick. If you take a look at the S&P 500, the overall rate of return of the S&P 500, there's been many studies here, and it looks at about 20 to 30% of the overall return of the S&P 500, that's 500 stocks, come from anywhere from 6 to 8 stocks. For you thinking that you could pick those stocks, it's like trying to pick the lottery winner. It's not going to happen. You can get lucky, but that is not an investment strategy. So you want to make sure that you're completely diversified. You have thousands of different companies, several different countries, and globally diversified across the world.
Absolutely. And then, of course, the next thing is a lot of us don't have much patience when it comes to investing. And really, when you think about it, patience means that you stay the course. You get the right investment strategy in the first place, which takes a little effort, but then you stay the course. And here's an example of what happens to most people, is they far underperform regular investment returns. So what you're seeing is on the left is a normal investment return. What's on the right is the investor return. And the Dalbar study they're a company in Massachusetts that look at this every year. The last 30 years, the market has gone up around 11% per year on average, and the average investors earn 3.5%. And why? Because they're buying and selling at the wrong times.
Right, and that's so common. You're buying and selling at the wrong time until you continue to go broke. Don't let that happen to you. What we're going to give away today to all of our viewers is a free investor toolkit. This is big. This is brand new from our company. You have to get your hands on this. We can walk you through it to make sure that you're not making mistakes. When markets are volatile, that's when people worry. That's when you make the wrong decisions. Call the number right now to get our investor toolkit, 888-994-6257. That's the number, 888-994-6257. We got a lot more to go. Don't go anywhere. Show's called Your Money or Wealth. Hey, welcome back to the program. Show's called Your Money or Wealth. Joe Anderson here, certified financial planner alongside Mr. Alan Clopine. We've got a great segment lined up. Mike Fenison will be joining us shortly. He's the CEO and founder of Pure Financial Advisors, so stick around there. But one of the most important things I want to get through today is that we put together a free right? Investor Toolkit. This will help you understand what you should be doing with the overall investments that you've saved, how to create the retirement income, how to save money in tax, understanding risk and return. You know what? That's the only thing that's really related in the overall markets. The more risk you take, right, the more volatile the portfolio. Do you know how much risk that you're taking? The answer is probably no. Call the number right now and figure out exactly what your portfolio is doing. And the number is 888-994-6257, or you can always go to purefinancial.com. With that being said, let's see how you did on the true false today.
Here we go. An index fund or exchange-traded fund generally holds many investments, which is good for diversification, and often has very low internal costs.
Yeah, that would be true. Ding, ding, ding.
That is true.
when we're looking at investment mistakes and looking at diversification, an exchange-traded fund, an index fund, a mutual fund, they hold hundreds of stocks inside that basket. So instead of buying one individual stock, you can buy hundreds of them at a very low cost if you use an index fund or an ETF.
Yeah, absolutely. And John Bogle had it right at Vanguard. Putting together funds that were very low cost, well diversified, and you just invest in them for the long term. But you don't just want one, you want to have several funds.
Yeah, and I think the problem, Al, with when people think of index fund or exchange, well, a lot of people don't really understand what an exchange-traded fund is, so we can probably dedicate a whole show of how it's packaged up. But when you hear index fund, it's not the S&P 500.
I mean,
right?
that is an index fund. That's one of them.
It's one of them. Yeah. It's one of many that you want to hold in a globally diversified portfolio. But then people get caught up in the hype all the time. It's like, well, what's the next IPO? Or should I get into Apple because iPhone 6 just came out? You know what? We put together something that you gotta ignore all of the hype that goes on in the investment world. Take a look at this.
Alibaba is creating a lot of buzz, becoming the largest company ever to go public and prompting many to make the #1 mistake of investing.
I think one of the biggest things and the biggest mistakes people make is they invest based on their emotion. We invest based on headlines and media and what's going on at that given time, and that always drives us to make the wrong decisions at the wrong time. It's kind of the same thing that we've seen time and time again. You have that hot stock, whether it's Alibaba or Facebook or whatever the new company is going to be, which might be a good, great, strong company. But the important thing to understand is that everyone knows that, right? And it's factored in, and of course, a lot of money can be made in IPOs, but a lot of money can be lost.
The success stories that help drive the emotional investing are stocks like Google. The stock could have been purchased for $100 in 2004 and sold for $597 in 2014. Apple could have been purchased in 1984 for $3.02 and sold for $336 in 2011. That's a 10,000% return. And Microsoft could have been purchased for 8 cents back in 1986. When adjusted for stock splits, it pays out in 2014 as $46 a share. It's the buy now or be left behind mentality that puts many people's retirement portfolios at risk.
We only hear about winners, right? So whether it's from a portfolio manager or a friend or a neighbor, whoever it might be, maybe especially us as guys, right? We tend not to tell you about what we didn't do so well, right? We want to brag about, hey, I invested in Apple before it went through the roof, or I invested in Microsoft early on, whatever it might be, not really referencing all the other stocks that I might have invested in before they completely failed. So we're only constantly hearing about the winners, but you always have to remember that there's a lot of other companies that haven't done well, for every winner that's out there.
Enron was considered a hot stock. It went from $90 a share to under $1 in just 15 months. That's a 99% loss. Bear Stearns and AIG stock prices plummeted and put many retirement plans in the red.
Especially when it's your portfolio and it's your nest egg, you don't want to take on that kind of risk that it would take to potentially earn substantial returns, because risk and return are related. So in order to take a shot at achieving a huge rate of return, I have to take a huge risk in order to attempt to achieve that. You don't want to gamble with your nest egg, right? There's just not the ability to make that money back again, especially as people near retirement.
Al, that's the biggest allurement of active management. When you take a look at some of these stocks, such as Apple, Microsoft, Google, the list goes on and on. When you see these huge returns, people get excited. That's that fear and greed. It's like, man, I want some of that. I don't want to necessarily be left behind. And so they're always looking for that golden nugget or that diamond in the rough, but it's so hard to actually find it.
Well, that's exactly right. And Joe, here in San Diego, remember it was Qualcomm a decade ago, 15 years ago? Everyone had to get Qualcomm. People that had Qualcomm and were working there, had stock options, were making a fortune. So we hear about this and we think maybe that's the way to invest, but we're here to tell you there are more failures or stocks that go sideways than the ones that hit home runs. But today I'm really excited because we have Mike Fenison, who is CEO and founder, certified financial planner of Pure Financial Advisors. He's also chairman of the investment committee. And Mike, we're going to talk a little bit about what we should do given all this noise in the market right now. And the market's volatile. So should we make any changes in our investment strategies given that the markets are kind of all over the place?
Well, the key word there is we, Al, and so I have to qualify the statement. The answer is no, we don't make a change in the investment policy. And the reason for that is that you have to know two things. You have to know how much risk is in your portfolio before you make that decision, and you have to know whether that risk is appropriate for your planning needs. And so for us, we know the answers to both of those, so we don't need to make a change.
So the first step really is to know how you should be invested in the first place. But once you have the right investment strategy for you, you don't necessarily want to make changes as the market fluctuates.
No, because you can't really predict market action. And the people that become most fearful about it are the ones that don't know how much risk is in their portfolio, and they hear the headlines and the hype in the media, which is all sensationalism that attracts attention, sells magazines and books and strategies, and creates new products to try to save the day. But in reality, there's no research that shows or even points to the fact that you can accurately predict the markets. And if you're going to try, you have to do it multiple times. Knowing when to get out doesn't help you if you don't know when to get back in.
Yeah, so how about this one, Mike, which is at this point in time, the press has a field day with the volatility. And so they come out, different people, different pundits come out and say, well, do this strategy, buy this. We've got this strategy for a sideways market. We've got this strategy when the market goes down. What do you make of all of that?
Well, all of those strategies will work some of the times if their predictions are correct, but all those strategies also incorporate costs. There's an expense to take any sort of hedging action against market direction. And what the research has shown is that that expense ends up being a net loss over time. So you might miss a short-term dip in the market, but it will cost you long-term total return. And that's why you want to have everything tied to your planning so that you know how much of a dip you can sustain and how much of a dip you could expect, even in the worst of circumstances, given how you're invested in your portfolio.
So planning first, figure out how you should be invested, and then stick with it. Rebalance is appropriate, tax manage is appropriate, but don't make wild swings.
No, all that keeps your risk consistent, and it needs to be consistent based on your planning. And if you're doing that and you know how much risk is in your portfolio and you know what the volatility might do to your portfolio over time, you don't need to make adjustments, because any adjustments that you make will end up costing you. It'll be emotionally driven, and that usually doesn't work out.
All right, Mike. Well, thanks so much for everything that you've been able to tell us here today.
Thanks,
you know, when you take a look at the overall markets, right, you can absolutely beat the markets, the portfolio managers, but can they do it with any probability over a long period of time? Is it possible? But it's not highly probable.
Yeah, that's the key.
And so you want to make sure that you have the right strategy. So here's the deal. All you got to do is call our number to get your investor toolkit to make sure that you're not making the same mistakes that most people do with their money. Here's the number. Once again, it's 888-994-6257. And it's absolutely free. It is no cost, but the information is priceless. I stole that from a commercial, if you know what I'm talking about. All right, we got to take a break. Don't go anywhere. Show's called Your Money and It's Your Wealth. Hey, welcome back to the program. Show's called Your Money or Wealth. Joe Anderson here, Big Al Clopine over there. Thanks for tuning in each and every Saturday, hanging out. Hopefully you're enjoying your weekend talking investing, some investor mistakes that you're making. And unfortunately, a lot of you make a lot of mistakes when you start looking at your portfolio. I'm not saying never to look at it, but the more you look at it, it's like the more you handle your investments, it's like a bar of soap, right? The more, you handle a lot of a bar of soap, the more you don't have. So, see, that's a really bad joke. And I'm just going to transition to me teaching classes all across Southern California. I see you looking at me, Al. Come learn your financial planning moves. I teach all over Southern California a retirement planning course. If you want to learn how to do this on your own, all you have to do is go to yourmoneyyourwealth.com and check out where I'll be teaching next. Right now it's the fall. It's about 3 or 4 nights a week. I'm at a local community college or a state school in Southern California. Go to Your Money, Your Wealth. It is free of charge. It's a 6-hour course. You'll learn everything that you need to know on how to put together a true financial plan. When it comes to creating retirement income in retirement, Social Security strategies, do you take the pension or the lump sum, some tax planning ideas, Roth IRAs, Roth conversions, how much should you contribute to your 401k? There's a lot of different tax law that just came out. I explain everything soup to nuts so you have a real defined plan to make sure that you can do all the things that you want to do. Let's go to the true-false question. Let's see how you did here.
When I'm approaching retirement, I should tilt my Roth IRA and non-retirement accounts toward asset classes with higher expected returns to take advantage of lower tax rates. And the answer to that is absolutely true. And this is missed by a lot of people. A lot of you guys put your stocks, your higher expected returns, in your IRA, in your 401k. And you know what? When you pull money out of those accounts, you pay what? Ordinary income tax, the highest of tax rates. If you put those same asset classes in the Roth IRA, you don't pay any tax because it's tax-free. Or in your non-retirement account, it's subject to capital gains, 15% tax, long-term capital gains, if you hold that asset for a year or more. So absolutely, put your more aggressive asset classes in your Roth and your non-retirement accounts.
So when you look at taking stocks, why you want to hold those also in an outside of your retirement account is because stocks are volatile. They go up and they go down. And so there's a tax planning move that you can take advantage of, but also you want to make sure that you do this correctly. Because if you take a look at what most people do, when the stock market is high, you get that greed factor, and then that's when they want to buy. But when the market starts to slide a little bit, then that's where, the fear factor comes in. That's when I want to get out. And then you continue to repeat that behavior until you're broke, because we're twice as fearful to lose money than we are to gain. And if you just put yourself in this position, let's say you had $1 million, and that $1 million grows to $2 million bucks. Okay, think about that for a second. Or that $1 million goes to 50,000 bucks. Which is going to affect your life more, right? If I have $1 million, it goes to $2 million. Yeah, that's great, but it's not truly going to affect my life if that $1 million went to 50,000. So you absolutely have to be wary of the downside risk of your overall portfolio. And when things get bad, you cannot sell out and go into cash. And that's what, a lot of times what most people do. And then that's why we see failure when it comes to people's overall retirement plan.
Right, that's absolutely right, Joe. So let's get in. Let's build on top of what Mike Fenison was talking about last segment. How should you properly allocate your portfolio? And what we would recommend is that you probably want to have 12 to 16 different asset classes. What's an asset class? Stocks are asset class, bonds, real estate, natural resources. Stocks could be large companies, small companies, international, growth, value, emerging markets. There's many different kinds of bonds. You want to have a little bit of real estate in your portfolio and a little bit of natural resources. That's your starting point. Then you want to figure out how to fill those various asset classes. And we would recommend that you go with low-cost index funds or ETF funds, because the retail mutual funds out there are very expensive, and research tells us that over time they do not beat the index. So it's important to stay low cost, but don't just buy and ignore. Rebalance your portfolio as appropriate. That simply means if you have one asset class that starts to make a run, sell a little bit of that to get back to your proper allocation, forcing you to sell higher. Buy the asset class that hasn't done as well. Your emotions would tell you to do just the opposite, but that's the way that you successfully invest. And then you also want to tax manage your investments, which, Joe, as you just mentioned, tax loss harvesting for assets outside your retirement accounts is gigantic.
Yeah, I mean, it can add significant value long term. And so what tax loss harvesting really is when you look at a tax managed account is that, all right, if I hold stocks outside of my retirement account and that stock goes down, or the stock mutual fund or the index fund ETF, whatever that you're using to fund your overall retirement, if that goes down, you want to sell it, but you want to buy something similar. You don't want to sell and go into cash. That's what most people do. That's why you fail. But if I buy something similar, then I can utilize that capital loss against any future capital gain in any capital asset. So now that will create a mechanism for me to create tax-free income when I start pulling the money out for a retirement income strategy. Because if you can pay less in tax, then you can take less risk in the overall portfolio. What the biggest mistake, I think, to sum this whole show up, is that most people do not have a specific strategy or a plan in place to make sure that they're funding their retirement, funding their kids' education, passing wealth to the next generation, whatever your goals are. People always hear the hot stock, the hot mutual fund, the hot topic of the day, and they go there. You want to start with a plan to figure out exactly what target rate of return do you need to generate with the money that you have. That is key. Then you're going to have more discipline when markets get a little bit shaky. You can control a few things. You can control fees and costs. You can control risk, and then you can control taxes. If you don't do those three things, then you can control your stomach when it takes over for your head. If you need any help whatsoever with this, get our free investor toolkit that we're giving away today. Absolutely no cost. Here's the number, 888-994-6257. That's 888-994-6257. 6257. That's 888-994-6257. Call that number right now. Everyone that calls today gets the free investor toolkit, absolutely no cost, free of charge. It doesn't get any better than that. Big Al, that's it for us today. Great job, buddy.
It was a fun show, and next week maybe we'll come up with 5 more mistakes because there's more that you guys are making.
Yeah, I'm sure we could come up with 50, but we'll probably change gears. We'll talk maybe tax planning, some different things that came out in the tax law just a couple of weeks ago that we want to get into. I want to thank Mike Fenison, CEO and founder of Pure Financial Advisors, for Big Al Clopine. My name's Joe Anderson. Join us every Saturday, 11 to 11:30, right here on your Channel 4 cable station. Have a wonderful, wonderful weekend, everyone.